Welcome back to the channel, guys. I'm basically looking at my own pies and looking at the pies I've released and also thinking about the balance within each and the weighting, because we obviously with the pies, you can set the percentages. It got me thinking around performance of funds and what the weighting should look like. And obviously LDGG was very new, quite an exciting fund for us here in the UK and Europe. But obviously you've got the stalwarts like the all world funds and the typical tracker funds like the S&P 500 and the NASDAQ. I thought I would pitch it against the kind of the benchmarks in my portfolio, which are those three, typically in my case, more the all world fund. Now, all of the kind of listings are in pounds just to create some level of consistency and not mess up the currency side of things a little bit. Note all the data is coming from the API that I'm paying for and also getting cross-checked against other sources. Again, I'll try and do my best to keep these things as accurate as possible. It's not always possible, but I try to do my best. The window frame that I'm looking at here is from the start of LDGG, which is around 12th of Jan 2026 to the 21st of August 2026. That's around about 158 trading days per fund. I am using the adjusted close total return. For those of you not aware, you've got obviously the starting price of the day, the mid-market price and the end date. I picked the end closing price of when it closed at market close. And then you get the adjusted close, which takes into account basically distributions in those funds. Hence they call it total return for adjusted close. Let's start to kind of look at the figures now. This is for GBP, GBX. And again, this is assuming £1,000 was initially invested. Now note, this is total return. So this is including any distributions that were being paid out since that period. And I've also brought in the max drawdown during that period as well. So the lowest point at which it dropped. We can see that LDGG did £1,140. So that's a 14% return. EQQQ, so the Qs, so the NASDAQ did £1,125, so that's a 12.5% return. VWRL, which is the all-world fund from Vanguard, did £1,103, so that's a 10.3% return. And then IUSA, which is basically the S&P 500, did £95, so 1,095, so a 9.5% total return during this period. What's quite interesting here is the actual LDGG fund did the best, even outperformed the two biggest typically seen indexes globally, which is the Qs, the NASDAQ and the S&P 500, but it also beat the all world as well. And it by a decent percentage. It's not a small percentage when we start talking about these mixed baskets funds. Now, when we look at this from a kind of specific data perspective, as I said, I've tried to get accuracy in terms of the data as best I can. And the trading days are slightly varied, not by much, but I just want to be as transparent as I can. And there may be some kind of currency FX stuff in here. Just kind of be mindful of that when you're looking at the funds that are in GBP, but dealing with US underlying. I just want to call that out very quickly. Okay, so let's dive into what each of the funds are. If we look at the LDGG, and I've done a separate video on this fund in particular, so go watch that if you haven't. But basically it's launched by Legal & General, and it's the Global Quality Dividends UCITS ETF. It is listed on the London Stock Exchange. As I said, the inception date was 12th of Jan 2026. It does have an index, so its index follows the FTSE Dev All Cap Dividend Growth with Quality Index. It has around about 200 holdings. It has a fairly reasonable expense ratio of 0.29%. Its AUM is around 207 million euros right now, and it is distributing monthly. The next one in the mix is the Vanguard FTSE All World UCITS ETF. Now, this is the distributing version. There is a accumulating version as well. VWRP is the accumulating version, which is actually the version I hold within my portfolio, but the performances are roughly equivalent. The index it follows is the FTSE All World, which is a global index of around 4,000 stocks. Its inception is 22nd of May 2012, so it's been around for a while now. As I said, the holdings are around 3,763. It has a slightly lower expense ratio of 0.22%, and it's a huge fund. AUM is $19.3 billion. However, it does distribute quarterly. We then have the IUSA, which is the iShares Core S&P 500 UCITS ETF, USD distributing. It is on the LSC, and this is your 500 largest companies. This fund was created around 26th of March 2010, and its AUM is around 12 billion. Its expense ratio is very low at 0.07%. And then we have the Invesco EQQQ NASDAQ. This is the equivalent of the NASDAQ 100, and that's the 100 largest non-financial companies in the US, and it's focused around tech and growth. And that was, the fund itself started on the 9th of December 2002, and it has a slightly higher expense ratio, in fact the highest on the list at 0.3%, but it has a fairly large AUM around 10 billion. And that is also quarterly distributing. If we look at these funds side by side, we can actually see, in terms of the actual total returns, we said LDGG is the best at 13.95% compared to all of the others during this period. Interestingly, the volatility is also the lowest of the four. This is how much it moves up and down across that period. And it is considerably lower than even the All World, which actually surprised me. I know there are quality companies in there, which is probably explaining this, but it did surprise me based on the fact that there are only 200 stocks in there. It wasn't a large basket. When you look at the basket size, if you look at the order, VWRL is considerably the largest. The max drawdown was, again, within the window of all the others. Most of them were in the 7 range, particularly for VWRL and the S&P 500. And then the deepest, which is no great surprise, is the NASDAQ with the tech-heavy allocation. In terms of expense ratio, it was still the second most expensive, however, of the batch, just behind EQQQ, so the NASDAQ fund. Now, if we look at this sort of from a monthly returns perspective, we can see how, obviously, as we know, LDGG came out on top, but it was fairly consistent on top on virtually every month, with the exception of around about 3 or 4 of them. It came out in Jan, it performed well in Jan, it performed well in February. The S&P 500 did better in March. In April, we had the NASDAQ for April and May. June, July, again, LDGG came out on top. And in August, which is where we are now, which is still a part period because we haven't quite finished August, we do have the NASDAQ slightly ahead. Hopefully that gives you some kind of clue around the performance. As I talked about in terms of the overall performance, it's considerably better than all the other funds. The other thing to bear in mind was the risk-return ratio. LDG sits in the top left zone, so higher return with lower volatility of the 4. And I think for people that are not great at handling volatility, I think this is a really good fund to help manage that in part of the portfolio. And also, if we look at risk-adjusted terms in this window, LDG also had quite a wide margin from that perspective. If we were to look at this like annualized return, we've got to bear in mind this is less than a year's worth of data. It's 7 months worth of data, not over a longer time horizon of like 14 years. As an annualized return, it's a bit inflated at 25%. But if we look across the other benchmarks, they're fairly consistent at 12 to 14. I don't expect this to continue. I think it'll be good to keep an eye on this fund, but I think it's certainly interesting what it's achieved in the time frame that it's been around for. When we talk about the top holdings, LDGG has a rule around its weighting. Typically, each one is 0.255 to 0.5% each. There's no single name that crosses that 0.5%. And I think this really manages that volatility and drawdown because there is such a even spread within those 200 or so holdings that they have. When we look at the other funds like VWRL, it's Mag 7 heavy. The top three are around 12.7% of the fund. When we look at the S&P 500, similar thing, Mag 7 mix. The top three this time is 18.4. And then when we look at the NASDAQ, it's even worse. The top 10 around 47.5% pure concentration of tech and growth. The next thing that comes quite relevant is where the sector mix sits for these four, which again can be a little bit surprising because normally we're used to seeing tech heavy funds across every majority of these kind of basket funds. Where LDGG differs is its financial weighting is 33%, its industrials is 19%, but you can see that the tech heaviness is very low at 5%. And when we compare that to the all world, tech is 32, financials is 15. If we look at the S&P, tech is 37, comms is 10, and financials is 12. And when we obviously go to the NASDAQ, the tech is 60 and comms is 13. We can already see an advantage that the tech exposure ranking is considerably lower. And this explains most of the differences in the volatility and the drawdown. LDGG is the only fund where tech is a kind of smaller portion rather than the heavy weighting. But how does it look from a geographical split? And by the way, guys, if you're enjoying the video, don't forget to hit that like button. And if you want similar content out there, don't forget to subscribe. We also have a Discord. I'll put a link in the description. So come join us there for talking to like-minded individuals. And again, if you want me to cover any other videos or any other funds, then just let me know in the comments. I did, in fact, get a request this morning from one of the members, and I will get a video out around what they've requested. When we talk about geographical split now, this is again where things get slightly interesting. When we look at LDGG, it is developed markets only, so no emerging markets. 35% US and 36% is European. There's a fairly good split there of European and US. As a European person from Europe, I'm quite keen to see that. And I still believe there is still a lot of undervalued equity, certainly within the European market still. We've got 36 in Europe, 35 in America, 24 in Asia. Note developed Australasia, 4%. Note that's not Australia, Australasia. And a tiny bit of emerging market at 1%. When we look at VWRL, this is truly global. 65% is still US heavy though. And there is 11% in emerging markets. North America, 65, Europe, 12, Asia around 10%, emerging markets, excluding Asia, is 5%, and Australasia is around 2%. When we move over to the S&P 500, obviously that's going to be US tech heavy, so it's 99.5% US. It's a single country bet. And similarly for the NASDAQ at 98%. There is still 1% of European dev and others. We can see how when we look at geographic split and we take out the sector split, the S&P and the NASDAQ, as we know, are very US centric. Similarly, the VWRL is 65% US, whereas LDGG has a fairly more balanced split across Europe, North America, and Asia, although it doesn't have any emerging market exposure. When we look at the fees, we know that the NASDAQ fee is slightly higher. Now, I would caveat there are multiple funds that cover these indexes when it comes to the S&P, when it comes to the NASDAQ, even when it comes to the all-world funds. I want to be very clear that you could get cheaper funds out there than what's quoted here potentially, and there are more expensive versions as well. I want to kind of be very careful around what I say in terms of the fees here, because there are other alternatives. And I know people will probably put in the comments, yeah, but there is another fund that's cheaper. I just want to give people an idea of the fees, what it could have on a large account or a smaller account, and the compounding cost of this, because this is where people forget these fees can compound over time and impact and hurt your total returns. But then you've also got the yield numbers there as well. The yield for LDGG is around 3.4%. I think they're trying to target 3 to 4%. VWRL is 1.6. Now, this is current yield. It's not yield on cost. Over time, as you average into these funds, your yield on cost could be very different. Okay, so if we bring everything together, we can kind of see how the index they're tracking is very different. We can see the diversification is very different. The fees are very different. The tech weighting, again, is hugely different. And this is really important for balance within my portfolio. I always say in everything, in the videos and in the Discord and in the community, and when I message you guys, when you message me directly, I always say when you're adding a fund or taking a fund out of your portfolio, try and understand what it's providing for your portfolio. And for me, LDGG is providing more diversity across geographically, but also sector weighting as well. And it's obviously giving me a fairly decent yield that is going to be fairly stable, I would hope, and not have the wild swings as you'd get from maybe an options fund or some of these other funds out there that are higher yielding. And obviously, I'm hoping that my yield on cost will compound over time. That's kind of why I like this fund for what it's doing within my portfolio from a balance perspective. That doesn't mean I'm replacing it with VWRL, but because VWRL does have emerging market exposure, it does do mid cap and large cap. Whereas typically when you look at dividend growth and quality, they are typically more large cap companies, to be fair, versus mid and small cap, because obviously they're well established and can afford to pay a dividend and keep that dividend going. Obviously, there is going to be some overlap. So I don't actually own any S&P 500 or NASDAQ, which a lot of people question. A lot of people find it strange, but I personally don't hold either of those two. And the predominant reason for that is that when I've got the All World Fund, it already has 65% US weighting, and I've already got all the names in the S&P 500 and the NASDAQ. So it's not really giving me any extra value over the other things I have in my portfolio. And LNG's fund will also have some overlap now, but I'll get a slightly greater yield. It's not really helping me, and it's just giving me another position that I then need to go and manage and maintain. Does it hurt my returns? Potentially, but from a balance perspective, I don't see the value in that. Now, there is some argument cases around potentially having some option strategies that sit on top of those two indexes, which I do have. But it's not like I don't have any direct exposure. I do through option strategies, through some other funds like EQQQ and a few others. But in terms of direct ownership of just pure S&P 500 and NASDAQ, I don't have any, and that's because it's not adding anything to my portfolio. If we look at this from a kind of bottom line perspective, what are the pros and the cons of each of these? The number one performing was LDGG, but it is a very new fund. Income first investors who want a 3.4% yield paid monthly with growth as a top up. Now, the only challenge I do have slightly with the yield is from a risk return perspective, risk-free rate is often referred to as, and that's when you can just put it in a standard interest fund, basically. It's paying about that much right now anyway, if not sometimes a little bit more. It shouldn't just be for the yield. I'm hoping that I'm getting the yield and a bit of growth in my total return will be above or similarly around what the world market or the S&P 500 is doing, which has averaged over the years around 10% return a year. And then people who are actively trying to avoid the tech-heavy concentration, which I'm not trying to avoid it, but I'm looking for some additional balance within my portfolio so that when tech has a massive drawdown, I have something that doesn't mean my whole portfolio crashes, and it reduces that fear that comes into people. It also supports a core satellite portfolio. VWRL is the core, which in my case it is, and then LDG adds a bit of an income sleeve on top of that with some extra diversity. Also, what I like about this fund is it has equal weighting. So there's no name that kind of overpowers the others. And so again, when a particular name has a crash, like Nvidia, let's say, it's not going to tank my entire portfolio. Investors who want both raw return and low volatility. So this is proving out to do both right now. And again, this is early days for this fund. When I talk about weighting, it still has a sensible weighting within my portfolio. However, I have a sense that this may grow over time as my confidence grows in the fund. The reason why you might not buy it is you don't have that battle-tested long track record, right? It's still only new, it's 7 months old. Note that it has no emerging markets exposure. Now, you can offset that with other funds in your portfolio, but it's worth calling out that it doesn't have any. It also keeps tech small, so it's not going to rally when tech rallies. And that's why it didn't have the outperformance in a couple of months that we saw. And the fees, it is still quite high compared to other index trackers. Now, it's not high for an income fund, in my opinion, but for a tracker fund, it is a little bit on the high side. And there isn't really an alternative for LDGG like there is for the other three. If we jump to VWRL now, it's more of a long-term set and forget investors who just want global market in one ticker. Okay. People who believe in the US that keeps dominating and want that exposure for free. It does have a solid track record through bull, bear, COVID, rate hikes, etc. And the balanced risk profile, it's the lowest max drawdown in the window at negative 7.1%. It does have a yield. Now, I think this yield is so low that I haven't even bothered with the distributing version. I've just kept the accumulating version and letting them kind of tick up as needed within the fund. It was important to note, by the way, another factor was I started investing over 20 years ago and I was using Hargreaves Lansdown, still am, and their fees for reinvestment was quite high. They were charging, I think, £10 per trade or something. I do use Trading 212 as a platform as well now, but that just didn't make it worthwhile. The other thing that people may not like about VWRL is obviously it has 65% US exposure despite that global name. And then you want an ESG screen. VWRL doesn't have an ESG screen, which, by the way, LDGG does. You also want a cheaper option. It's not the cheapest option out there. There are cheaper funds, indexes out there. Let's jump into the iShares, so the S&P 500. UK investors who want pure S&P 500 exposure with no currency mix. Cost sensitivity investors where you want a low expense ratio. People who want quarterly distributions, want long-term large cap US bet with a 16-year track record. There is a lot going for the S&P 500. Okay, it's still used as a benchmark for a lot of funds out there. Are you beating the S&P 500 is always the slogan that you hear. If you want to avoid it, you want some internal sort of international diversification. It is very US heavy, and that may be something that you may want to avoid. Again, just looking at it from a growth perspective, do you want broader tech growth exposure? And what do you think the US long-term performance will be versus the rest of the world then becomes a question. And then we jump into the NASDAQ. This is a real high conviction on tech and growth. And people who think that AI, the CapEx cycle, has another at least 2 to 3 years to run, aggressive satellite holding alongside a global core. And it does have a really good track record based on the NASDAQ. Now, you may want to avoid it if you need any defense sector exposure. You want financials or energy as an example. But you can also stomach massive drawdowns. In the 6 weeks between February and March, it had a drawdown of negative 10%, for example. And I think investing is a mindset, and a lot of the time people pull out because of that mindset. If you're stronger mindseted, then this fund is probably okay. If you're on the weaker side of things or you're newer to investing, these are the risks. And you want lower fees, right? the fees can be quite expensive. Again, there are multiple NASDAQ funds. So again, fees, take it with a pinch of salt because there are potentially cheaper ones out there than the one that I've actually picked. All 4 funds I've covered were focused around GBP and GPX, and that's because I just wanted to remove the currency noise. If I'd created a mixed currency, then the FX would have played a bit too much. But the headline ranking has shifted, which is that LDGG has moved into first place at 14% return, with NASDAQ second at 12.5%, the global all world at 10.3%, and the S&P at 9.5%. The first 2 months of the window favoured LDGG. The April-May AI rally favoured NASDAQ. The August cool-off hit all 4 roughly equally, and hence why LDG is now winning on both raw return and risk. The most important single number is the return risk ratio, and LDG is 1.43, VWRL is 0.88, the S&P 500 is 0.85, and the NASDAQ is 0.7. In a risk-adjusted terms, LDGG is the most efficient of the 4 by quite a margin, and its dividend quality mandate actually delivered during this window. Whether this survives a real bear market is a different question, and the answer is we don't know yet. 7 months is still a really short track record. Let me know in the comments your thoughts. I've got it at a current 10% of my portfolio. I got a feeling it'll probably settle at around 15% of the portfolio overall. And that's quite a big weighting for my portfolio because it is quite a big mix and I've been investing for quite a long time. Let me know in the comments where it sits within your portfolio. What weighting do you have? If you own the pie, then I know it's weighting, but just want to know your thoughts. And should we really be adjusting this in the pie is another question. Should we be increasing it? I'd love to know people's thoughts in the comments. Thanks for watching. Hopefully you like this video. Don't forget to that like button. If you haven't subscribed already, don't forget to subscribe, and I'll catch you on the next one.